Meta stock is deeply undervalued right now, but does that mean it's time to buy? In today's video, we're doing a deep dive into Meta stock. We'll explore the company's business model, their moat, and company fundamentals. We'll also be looking at the risks around Meta stock and discuss the company's valuation towards the end. I'm currently rebalancing my portfolio, and as part of that process, I'm buying more Meta stock. I currently own $150 worth of Meta stock. However, when I buy shares, I gradually build my position over time. Once I'm done buying, my Meta position will make up around $1,250 or around 12.5% of my $10,000 portfolio. If you don't already know, Meta owns and operates social platforms, hence the name. These platforms include Facebook, founded by Mark Zuckerberg, who's still the CEO today, Instagram, which they acquired in 2012 for around $1 billion, and WhatsApp, which they acquired in 2014 for approximately $16 billion. So how do they actually make money? The vast majority of revenue comes from advertising. Meta places ads on its platforms, mainly Facebook and Instagram, which are highly targeted because Meta uses its huge well of user data to accurately show ads to people who might already be interested in the advertiser's product or service. This is why advertising spend has been shifting away from traditional sources such as TV towards more targeted social media ads. The more accurate targeting via Facebook and Instagram increases the profitability and return on investment for advertisers. That's why they love Meta platforms. Meta makes money based on how many impressions or clicks an advertiser has received. Therefore, the model is not reliant on the advertiser making a sale, but rather just getting the product in front of Meta's user base. About 98% of Meta's revenue comes from advertising, and 95% of that comes from just Facebook and Instagram. Instagram now produces roughly $70 billion in revenue for Meta, making it one of the most successful acquisitions in history. The company also has its Reality Labs segment, which is a comparatively negligible revenue source and a money loser in terms of profitability. Reality Labs is focused on virtual reality, augmented reality, and advanced AI research. You might have seen one of their headsets, the Meta Quest, advertised recently. This division is a sore spot for investors because they're currently losing huge sums of money every year. Around $18 billion in operating losses in 2024 alone. So why does Meta keep funding this money-losing segment? Mark Zuckerberg believes that augmented reality glasses are the next major computing platform like the iPhone was back in the late 2000s. If this is the case and Reality Labs succeeds, it will also reduce the company's dependence on other operating systems provided by Apple and Alphabet via iOS and Android. I'm personally not a fan of Meta's huge bet on Reality Labs. However, I trust Mark Zuckerberg's leadership, and the wider business model is strong enough that if he's wrong about AR glasses being the future, the company will continue to thrive regardless. Now let's take a look at how Meta defends its business against competition, also known as its moat. Meta is probably the clearest example of a network effect. Network effects are when a product or service becomes more valuable as more people use it. As we can see from the chart, Meta's network is by far the largest social media ecosystem in the world, with over 3.5 billion daily active users. The power of this existing user base is huge because most people only have a few different social media accounts. So if they're going to have any, it will probably be Facebook or Instagram. Other platforms exist like Reddit, Snapchat, and X. However, none of them come close to Facebook and Instagram's combined 5 billion monthly active users. Social media content is user generated, so if someone wants to build a business by creating content, they're probably not going to bother with the smaller networks until they've cracked the algorithm on Facebook and Instagram. This leads to a higher abundance of quality content on their platforms, which keeps users engaged and spending more time on the app, allowing Meta to show them more ads, which is what keeps advertisers locked into the Meta ecosystem rather than risking their ad budget on smaller platforms. Therefore, Meta's network effect cements their position as the top dog in social media. Meta's huge user base is the foundation for their data advantage, which keeps users engaged and advertisers locked in. The company's business model and moat are great, and understanding those two factors is important. However, we also need to check the fundamentals. These are the numbers that confirm the overall story of the company. When analyzing a company's fundamentals, I first like to look at their expenses. This gives me an idea about what type of company it is. You can often understand a company's business model just from looking at how they spend their money. As you can see from the chart, Meta's expenses have grown as the underlying business has also grown. The large blue bar is Meta's capital expenditures. These are investments made to upgrade the operations of the business, and as discussed previously, investors are worried that Meta's increasing capex is being spent inefficiently. Capex currently sits at $63 billion over the last 12 months, which is more than double their capex spend in 2024, which was around $31 billion. And the company's management have already announced that spending will be notably higher in 2026. Management has repeatedly tied capex to measurable improvements in ad performance. In their latest quarterly earnings, ad impressions were up 14% and pricing up 10%, driven by AI improvements in targeting and conversion modeling. Like I said, the market is worried about their spending, but I believe Meta is positioned to achieve significant returns on these investments due to higher user engagement and higher ad rates. In terms of capital allocation, this meaning how management is spending shareholder money, the company is becoming a buyback machine. A buyback machine is a company that uses its excess free cash flow to buy back its shares, increasing the ownership of existing shareholders. I see this as a positive development. However, it would be nice if the company increased the rate of buybacks because they're generally more beneficial when a stock is undervalued, like I believe it is today. Meta also introduced a dividend back in early 2024 to be paid every quarter, and that dividend has grown at a rate of 5% year over year. We've already looked at the risk related to increasing AI capex. Therefore, because we've already covered that, I want to explore a different risk that investors may be missing right now. The main risk I see as a Meta investor is the company's increasing stock-based compensation relative to free cash flow. This partly ties into my point about increasing share buybacks because the company is issuing so many new shares as compensation to employees, which dilutes the existing shareholder base. The company's 1% share buybacks are barely covering the increase in stock-based compensation, hence my desire for the company to increase their buyback program. Stock-based compensation isn't always a bad thing, however, Meta seems heavily reliant on it, so it's something to be aware of as an investor in the company. Now let's look at valuation. Meta is currently trading at 20 times 2027's projected earnings, which is lower than Amazon at 25 times, Alphabet at 24 times, and Microsoft at 25 times. These companies are all more diversified than Meta, but around the same scale in terms of revenue. Meta even has higher profit margins than Amazon and Alphabet. If we look at Meta using the DCF calculator on Qualtrim, we can pretty reasonably assume an 18% EPS growth rate, as the company's average over the past 5 years was 20%, and the EPS is actually accelerating over time due to higher user engagement and therefore ad rates. The 6% growth over the last year was negatively impacted by a one-time tax charge of $16 billion. Adding the tax charge back would have meant an EPS growth rate close to 19% year over year. Then, if we assume an appropriate PE multiple of 26, which I believe is pretty conservative, you're looking at 15% annualized returns from today's price. The wider market usually returns around 10% on average, so 15% looks pretty good. If you enjoyed this video, click the next one for more.